I gave you in a previous webinar this example just to give you an idea of what the 1,000 pip range moves actually look like. And within that 1,000 pip range, how we have several completions of multiple large quarters. The example that I gave you here is the dollar versus the Japanese yen. And it shows you about 3 months from February until April of 2009. As we can see here in the beginning of the period, the major large quarter point at 90 yen is reached. Prices enter above the major large quarter point at 90 yen. They make a move towards the large quarter point above at 92.50 yen. However, on the first attempt, the large quarter there is not very successfully completed. We have prices pulling back to the preceding large quarter point. They don't break below 90 yen, and they make another attempt to complete the same large quarter, targeting the large quarter point at 92.50. Ultimately, on a second attempt, that large quarter is successfully completed. As you can see here in the circle, prices have reached 92.50 large quarter point. Then they break above the large quarter point at 92.50, make the first attempt, pull back to the preceding large quarter point, continue forward, and then complete another second large quarter of 1,000 pips to the major half point, as I like to call it. That is the exact half point of the 1,000 pip range between 90 and 100 yen. That will be the 95 yen level. Prices continue even forward, completing the next large quarter between 95 yen and 97.50 yen. As you can see, they even surpass above 97.50 large quarter point, pull back, don't break below 97.50, make another attempt, unsuccessful, pull back to the preceding large quarter point, third attempt to complete the large quarter. Finally, after 3 unsuccessful attempts, the final large quarter of the 1,000 pip range between 90 and 100 yen is not successfully completed. Prices pull back to the major half point of the 1,000 pip range, and then in the next several weeks, we have that quarter between 95 and 97.50 yen successfully completed, and then finally, even the large quarter between 97.50 and 100 yen is successfully completed. So what does that basically mean? That means that the dollar-yen exchange rate in those 3 months has not only managed to complete several large quarters of 250 pips each, but it has managed to complete the entire 1,000 pip range between 90 and 100 yen. Now, what happens here is obviously we see prices breaking above the 90 yen level. That is what I call a 1,000 pip range transition, where prices have at that point transitioned from the previous 1,000 pip range, which was the range between 80 and 90 yen, and have entered the new 1,000 pip range between 90 and 100 yen. Why did these transitions happen? Are they random events? Absolutely not. I explain in my book, The Quarters Theory, what the main reason for these 1,000 pip range transitions are. The market normally tends to price in things in advance, especially when it comes to the fundamental backdrop of certain currencies that are formed in that currency pair. Here's, for example, the weekly chart of the euro-dollar pair. Now, this is going to take us all the way back to the final month of 2009, which is, of course, December of 2009. Now, you would recall that even beyond here, the euro-dollar pair was trading within a range of 1,000 pip range between $1.50 and $1.60. If you recall, in November, wasn't it, or early December, euro-dollar pair was trading at $1.5140, if I'm not mistaken, was that the high for 2009. However, when the fundamental backdrop for the euro and the US dollar began to change, and the market quickly realized that obviously the current underlying fundamentals no longer and exchange rate at that time no longer represented correctly the euro-dollar pair's exchange rate, meaning that at the $1.51, in light of the Dubai debt crisis, if you recall, which happened around Thanksgiving weekend in November, and that sort of started it all, when we started seeing massive risk aversion, when we started seeing the first days and weeks of the Greek debt crisis, which ultimately now has turned into the European Union debt crisis, and you know how that has gone, since the final month of 2009, the euro has began to weaken. And what it has started to do at that point, the euro-dollar exchange rate has began transitioning into multiple, not only multiple large quarters, but also multiple 1,000 pip ranges. For example, you will see there in December, the euro-dollar pair has already fallen from the 1,000 pip range above $1.50, between $1.50 and $1.60, and has transitioned into a brand new 1,000 pip range between $1.40 and $1.50. Now, the market at that point realized that exchange rate between the euro-US dollar above $1.50 no longer represents the fundamental backdrop for the euro versus the US dollar. The euro was a very strong currency for the majority of 2009 as the market found the bottom and began to recover. They found the bottom in February, March of 2009. Until the end of the year, the euro managed to jump from $23.28 to $51.40 something, if I'm not mistaken. But ultimately, when things started changing, of course, with the Dubai debt crisis and then turning into the Greek debt crisis and the Eurozone debt crisis, we started seeing the euro-dollar currency pair giving us that phenomenon that I explained in my Forex theory book. And that's the 1,000 pip range transition. Just to give you a quick example, you will see here that by the week of December 29th, the euro-dollar pair has already fallen to a low at $1.4257. Okay, many of traders who are not familiar with the quarters theory would probably think that that low at $1.4257 was a complete coincidence. To me, that is not a coincidence. When you think in terms of the methodologies of the quarters theory, $1.4250 is a very important price level there. If you're guessing that's a large quarter point, then you're absolutely right.